Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. And we all welcome you back this week with a new episode with our founder and president, Mr. John Woodard. Get in this week's episode, always buy quality and diversify. What exactly does that mean? It's been a motto of ours basically since the beginning. So this episode, we're going to be digging into what exactly the history is, why my father coined the term, and actually it's a registered trademark now, and just exactly how it applies to our portfolios and the full history behind it. So getting started here, thank you again for being on the podcast as always. And if you don't mind telling the audience here exactly what buy quality and diversify means and why that is our motto for the firm.
Okay. When I started Woodard & Company in 1985, once again, I'd been in the business for 6 years or so, starting with E.F. Hutton, a Wall Street brokerage firm in the 70s. And when I started Woodard & Company, I gave it a lot of thought, like what are the most important factors and what is the best way to manage money? And I was like, well, diversification is critical. You see concentration of assets, like we saw people a few years ago, well, more than a few, but here in Winston-Salem, North Carolina is the home of Krispy Kreme donuts. And a lot of people would concentrate their portfolio in Krispy Kreme. The stock, it was doing incredible. It went up exponentially for a period of about 2 years, I think it was. But then it crashed and went down to pennies on the dollar. And lack of diversification. And there's also it's a mobile home manufacturer. They're the best known, the biggest. Had a place out near the airport between Winston and Greensboro, and the name eludes me. But one time I had a client, and he came in and he said, I have my entire retirement plan in company stock. It's over $1 million, and this was in the 90s. $1 million, it was early to mid 90s. Quite a bit of money, and I wish I could remember the name of this company. And the stock, we looked at it, and it had done like 33% a year, something like 34% a year for 20 years.
Goodness.
And he said, Mr. Woodard, what can you do that would be better than that? And I said, well, not many things have returned 34% a year. I said, there are other companies, other stocks that have, Coca-Cola and others at that time. I said, but diversification is critical. If something happens to the company, you're out of luck. And I said, you could lose it all. And so he called me 2 years later. They'd gone bankrupt, and his retirement plans were worth nothing. Well, you can look at, if you want to go local here, look at
That's unreal.
A lot of folks used Wachovia Bank stock for money. We have a client who had his mother passed away. These well-known people. She had in her estate, she had $25 million. She had 3 sons. One of them was an attorney. One of them was blind, and there was a third one. And the attorney used Wachovia Bank stock as a substitute for money market.
A stock instead of money market.
The consistency of it was remarkable. The dividend yield was like 5-6%. I mean, it was great. And this was in September of 2008.
Not a good time.
Not a good time for the banks, especially for Wachovia. And he put the entire estate in that. Now the attorney was a very wealthy man, and he had no problems. But the one son who didn't have any vision, Wachovia soon went out. That whole estate disappeared. So I mean, I've got story after story, and I'll stop with that. But I've got
diversification.
Dozens of stories about diversification.
Just people always want, because it looks good if you put all your eggs in one basket. Like if you put in NVIDIA in 2017, you could have turned $1,000 into maybe like 5,000 into $1 million, which looks great, but if things go south.
And you want sector diversification too. Let's say you put it all in tech and it was 1999. Well, you made a killing in 99. In 2000, you got killed. So you can diversify the sector, and a lot of people, concentrate in gold. Well, if the dollar is weak, you're making money. Look at the last 90 days. Gold's gone up. But before that, gold hit a high 5,500 and went to 4,000. Went down like 30%. Why is that? The dollar was strong. And so a lot of what Warsh is doing, a lot of what Besant's doing is fixing the economy, and there's lots of problems. But if they do fix it, strong dollar is a sign of a strong economy, and so we may be heading back that way. So all your money in gold is probably not a good idea.
All your money in anything, it seems like.
Exactly. Once again, I remember in '81 when I was hunting, gold hit $800 an ounce. It didn't get back to 800 until 2000 and something, like 25 years later.
08 or something like
yeah,
that?
Yeah, something like that. I think it was 08, yeah. And so like 25, 30 years later, it gets back to where it was, maybe more than 30 years.
Same for silver. Silver,
yeah.
It took ages.
So diversification, but of course, you can also you can buy other assets and have diversification because you're buying garbage, and so that leads to quality. So you want diversification in your portfolio, but you also want quality. And
could you emphasize a little bit more on quality? Just what that would be, just because some people might think certain stocks, they all look like quality, but maybe mention a little bit about penny stocks or.
Let me tell you,
that sort.
And in the early 1980s, there was actually a stock exchange in Denver, Colorado, and it was the for penny stocks. And that thing was red hot, and it was going crazy. And then all of a sudden, the SEC got involved because there's a lot of touting and running these little things up. There were, they'd get a 50-cent stock and run it to $18 and this kind of thing, and it was not with valid information. They'd have touts on the phone running these things, and these what do they call them, boiler shops or something, and they'd run these stocks. And you'd have all these small independent brokerage firms doing this kind of thing. So actually, Buy Quality and Diversify was in conjunction with our stock portfolio market leaders. Okay. And so when I went to design that, if I might, okay,
yes,
we'll slide into it.
A little bit of that.
Okay. Yeah. So on the diversification, we looked at the S&P 500, which is representative of industry in the United States, in business in the United States. And so, like if there's 12% financials, we'll have roughly 12% financials. Or if there's 34% technology, we'll have 30. In other words, so we're diversified in the various sectors relative to the S&P, and that's a good thing because the S&P has a support that you may not think of. If a lot of institutions are mandated to keep an allocation of 70-30, for example, charitable organizations, it's the standard. Well, and what are they going to do? They're going to buy the S&P.
When you say 70-30, 70%
stocks to bonds.
Yes. Okay.
Yeah. And so you've got this, and also you got all these 401ks, all this money flowing into S&P 500 index fund month after month after month, year after year. It's not flowing into international. Some of it would, but the majority of that river, emerging markets or micro caps and all these other things. You can diversify into them, but if you look at the history, you're 32% of the S&P 500 revenues come from foreign countries. So you got international if you got the S&P.
Yeah.
So anyway, so market leaders, our stock portfolio, we diversified, but we're diversified relative to the anchor tenants of the S&P 500. And that's one of the reasons why in 2000, 2001, 2002, we were actually about flat, but the S&P fell 50% with a tech rate. But our reallocations and diversifications kind of kept us. We actually had underweighted the techs a little bit in February, which kind of helped. But
that would help just a little bit.
It would. But you think about quality. If a company, like Procter and Gamble, they make Tide detergent, they make Crest toothpaste. People are going to brush their teeth. They're going to wash their clothes no matter what happens in the economy. So you've got that. You've got anchors like Johnson and Johnson. They make baby shampoo, but they also make Band-Aids, and then they also make very technical medical devices and medicines. I mean, so you've got diversification within. If it's a large company, you have diversification within that company. You look at the product line for Procter and Gamble. It's like 58 products. You've got all this diversification, and that gives you a safety too. But you've also got professional management, and it's not just professional management. It's professional management that has demonstrated that they're very competent and capable.
For decades, if not centuries.
Yeah. Procter and Gamble goes back to what year in the
It was late 1800s, maybe?
1800s, yeah. Like Coca-Cola goes back to the 1880s, I think. So you've got, and if these companies are leaders and they're the leaders are going to be the high quality ones. They're going to be able to recruit and retain the best and the brightest. They're going to have the capital for research and development or for acquisitions.
That's the economies of scale. They're able to, if there's some startup company that has some really good technology, most likely they'll have the money to just put in and acquire them. And
you can hit a hot dot, and you can really, and if you go back to the 1970s, and if you're old enough, you'll remember there's something called the Polaroid land camera, and everybody you could take a picture and it developed right there in your hand. I mean, you could be holding it, and everybody had one. I didn't. I thought they were expensive, but anyway, just the whole country seemed to have one, and the stock was trading at some $400 a share, and then people looked around and said, "That's the only product they got," and it eventually went to, I think, $12 a share, something like that. So that's another example of diversification, but it's also diversification within the company itself is good.
Yeah. Okay. Great. Well, I feel like that really rounds out just market leaders and all that. Would you like to tell the audience a little bit about how you thought of it? I mean, we understand your reasoning behind it, but just a little story of where that came about.
Well, yeah, it's interesting. Joan and I were going. We're in Williamsburg, Virginia, and there's a road, and it's a scenic byway that connects Williamsburg and Jamestown and Yorktown out there. And it is the most beautiful road, and it's got the village where Pocahontas's
cool.
It was their village and all this stuff is absolutely. There's no back then in 1984, 85 when there weren't as many people, and a lot of soul on the road. And John and I were talking, and I was trying to formulate what I wanted to, how I wanted to.
Have a brand for the name.
Yeah. And also the philosophy behind what we do. Because it's not just a brand name. It's the philosophy, is the basic philosophy of what we do. And I said, we want diversification, we want quality. And I was like, always buy quality and diversify. And we had a great day at Jamestown and at Yorktown. Beautiful
to
day.
Top it off.
Yeah.
That's good. That's something that is fit throughout all time in history, up until now, and it's a philosophy that stands true through the test of time.
It really does.
Seems like.
It really does. Yeah.
So wonderful. Well, thank you. I think now it's good the audience now knows just the backstory of it all, and getting into the pick this week. It's another restaurant we're going into, Daingerfield's restaurant. It's inside the Westglow Resort and Spa out in Blowing Rock, North Carolina. It's a place we like to go to from time to time. They have really good, just a great atmosphere. The three things I like about a restaurant: service, food, and atmosphere. All three are hit typically top notch.
It's an elegant mansion with big white columns on a hill overlooking the mountains that an artist named Elliot Daingerfield, who was obviously a very wealthy man, he built this. And the guy that owns Gideon's Ridge and several other things, he is one of the investors, and they have just, in the last couple of years, they've
put out the restaurant.
Yeah, put it all back together. Yeah.
So it's a great place to go. And Blowing Rock in general, I mean, this time of year is optimal to go to. I mean, that's something you were saying right before we got on here, that the average temperature in the summer is 75 degrees.
It's I think it's in the 40s at night right now this week, and the high 40s. But the highs, and I think I looked at it's going to be like 70 to 72 every day this week.
That's unreal.
Yeah, it is.
That's a nice little.
But the atmosphere and the food and everything is service it's delightful.
It's great
at Daingerfield. Yeah,
that's one thing. It's just another little restaurant in Blowing Rock. It makes it so good. It's a great place. If they just had the one niche to it is if they had white tablecloths, that would top it up being the most.
In case y'all haven't guessed, he likes to eat. So
who knows?
Yeah, I don't mind.
I do like to eat. Anyways, that is a great spot. Recommended if you're ever in the area there. So that concludes today's episode. We all thank you in for listening. And please remember to always buy quality and diversify. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involves risks, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional